Uh, may I ask Rajdeep Sharma to please share their start their to take the presentation on their paper titled "Predictability of Emerging Market ERP: Conditional on Economic Policy Uncertainty." The discussant is Vimal Balasubramaniam. Over to you.
Yeah, sure. Thanks.
And
Yeah.
just, I'm sorry, you had, I didn't say this when you were not here. So we have 20 minutes for the speaker and 10 minutes for the discussion.
Okay,
Thank you.
sure. Yeah. So first of all, I want to thank the organizing committee of the Emerging Markets Conference for inviting me to speak. The topic is on prediction of emerging market equity risk premium. Uh, Normally, equity risk premium is a key determinant of investment flows in an economy. So what happens is that up till now, the literature on equity risk premium has focused on equity risk premium prediction of developed markets, particularly the US market. Seminal papers in this area are Goel and Welch in 2008 and Rapak et al. In 2010 in RFS. And both of them show that the information contained in dividend payout, cash flows, macroeconomic indicators like yields, term structure of interest rates, market volatility have superior in-sample predictability of ERP. But when we test their prediction in an out-of-sample setting, they perform very poorly. And general conclusion from the paper of Goel is that if you just take the average of the equity risk premium in the historically, if you just use that as a forecast for the next period ERP, that does a better job than using complicated models or complicated predictions or selecting a range of predictors. Rapak takes this literature forward in 2010, and he says that if you combine the forecast of each of the individual predictors that you have chosen, then the combination forecast, you do a simple average of this forecast, does better job than even the historical ERP. So that is how Rapak moves the Welch and Goel's paper forward. We step in and we show that we devise a novel procedure for developing a predictor combination that beats even the mean combination of Rapak, and we test this prediction power in the setting of an emerging market like India. Why do we focus on emerging market? The first concern is that because of all studies focused on developed markets, but that is a second order effect. The first order concern is that emerging markets have a country risk premium, as documented by Damodaran, and the economic policy uncertainty in emerging markets are at a level higher than those of developed markets. And moreover, the economic policy uncertainty is much more volatile than the US market. That is there in the paper. The graph is not there in the slide, but we have seen that we have compared the EPU time series of economic policy uncertainty, which is EPU. I have compared it for Brazil, China, Russia, BRICS country with US, Europe, Japan, and we have seen there's a systematically higher EPU in emerging markets with higher volatility. And thirdly, there is a rich body of research that has shown that emerging markets, the market integration of emerging markets with developed markets have been varying over time, and gradually emerging markets are becoming more integrated. And one particular evidence of this is more FII flows that Indian markets or the Chinese markets are receiving over time. So in this paper, we present a benchmark study for predicting an emerging markets ERP. So we look at three potential factors other than the standard set of predictors used in the literature. Bear in mind that economic policy uncertainty we are using like a regime variable. We condition our forecast based on this. I'll come to it in greater detail later, but we are not using it in the regression model. We are not using it as a predictor. Second and third are the ones that we are using as predictors and the new contribution to the literature. The one is foreign institutional investor flows, because foreign institutional investors flows react on Fed rate hikes and all, but their movements have an important implication on the Indian stock market, and henceforth they reflect the changing expectations about ERP. And we have also observed, and it has been well documented in literature, that foreign investors follow a trend chasing behavior. And to capture this trend chasing, we take the S&P 500, which is the broad-based market portfolio in the US, and the Nifty 500, which is a broad-based market portfolio in India. We take this ratio. So whenever this ratio, by definition, this ratio, if there was no trend chasing, this ratio would have been a mean reverting ratio. The trend chasing behavior would force it to be a mean reversion. So whenever the ratio is too far away from its mean level, the trend chasing behavior of investors and ensure that it comes back to the mean. So that is how we capture the prediction of ERP. This variable has information useful for predicting ERP. So this is the standard set of variables. So other than the last two rows, the rest all have been used in the Rapak's paper and Goel's paper in the setting of US markets. These two variables are our additional inputs. We use their simple model, that is, we use the predictors in a simple regression setup. That is to say that we use the predictors one after the other, and we run this model again individually to test the prediction power of each of the 17 individual predictors. Our data is from 2004 till 2020. So our training period starts in 2004 and ends in the first sample size is 75 months, and we use a expanding window estimation. So each month, we from starting with 75, we predict the 76th month ERP. Then we take the in-sample window to 76 months, we predict the 77th month ERP, and so on and so forth. We go from November 2010 to November 2020 out of sample forecast. Another thing we must bear in mind that Goel and Rapak had done quarterly ERP prediction. We are doing it at a higher frequency, which is at a monthly level. So we get 121 out of sample forecast for each of the predictors, 1 month ahead forecast. And we also construct the mean combination forecast, which is the simple average of the forecast of the 16 individual predictors. Now we step in and we say that a certain predictor might systematically outperform other predictors during periods of low economic uncertainty, while a different predictor might outperform other predictors during periods of high uncertainty. So this has not been accounted for on a real-time basis. So a trader cannot use the Rapak's Rapak's conclusions in this paper, because though his conclusions are based on a backtesting procedure. So it has already happened and it tests which predictor performs well in which period. On the contrary, our paper can be used in a real-time setting because we are always forward-looking. So and we condition, and each month in the out-of-sample period, intuitively what we do is each month in the out-of-sample period, we classify it as either a low, high, or moderate EPU regime. And how do we do that? We take the empirical distribution of in-sample EPU values. We take the 20th percentile, and values below 20th percentile is the low EPU range of values. Values above the 80th percentile is the high EPU range of values, and in between is the moderate EPU. So we take the current month EPU and see where it lies on the empirical distribution, and we classify that as next month's going forward, because EPU tend to be persistent over more than 1 month. So we take the current month EPU and say that it is the forecast. Next month also EPU is going to be low, high, or moderate based on the empirical distribution. Now, ex ante, so this I have already discussed. Ex ante, we cannot know which predictor will do well because we are not relying on a backtesting procedure. So we rely on the modern computational power. So what we do is we allow for the possibility that any predictor may be good in low. Any of the 17 predictors may perform superior in the low uncertainty regime. So likewise, any of the 17 predictors will perform in the moderate and the high uncertainty regime. So we generate 3 tuples, which is an ordered set of 3 predictors, where the first predictor is, suppose, for example, to make it easier to explain, suppose the 3 tuple is dividend payout, cash flow to price, and FII flows. So what we do is we select the forecast of dividend payout in low uncertainty, select the forecast of cash flow in moderate uncertainty, select the forecast of FII flows in high uncertainty, and we generate the forecast series accordingly, and then we test the out of sample accuracy, how accurate it is. So we have, because we have 16 predictors, we have 4096 combinations. We test 4096 combinations out of sample forecast series, and we see which is the best. And the best one, we call it the dynamic EPU condition predictor. This is the predictor. We rank order them based on the forecast accuracy. How do we do that? We use the Clark and McCracken's test statistic, which because we use this test statistic to use the R square OS statistic proposed by Clark and McCracken to test what is the forecast accuracy. We test the null hypothesis that their forecast accuracy is not different from historical mean. And if the null hypothesis is rejected, we say it is superior than historical mean. Why do we need the Clark and McCracken rather than the standard Diebold-Mariano statistic? Is because this model is nested. So if we restrict beta 1 to 0 in this model, we will end up with ERP as historical mean, because it will beta 0 is the historical mean. So because of the nested structure, we cannot use a simple focus accuracy test and have to rely on a slightly more involved Clark and McCracken test. And because we have 121 out of sample forecast, Clark and McCracken has shown that if the sample size is low or moderate, it has a non-standard distribution. So we want to protect ourselves from getting p values that are not really evidence of rejection of the null. So we do a bootstrap, non-parametric bootstrap on the forecast to generate the to generate sampling distribution of the R square OS statistic, and from that we infer p values and the resulting significance. So this is a benchmark table. If you see the last column, the dynamic EPU condition predictor has the highest R square OS, and it's strongly significant. It beats the mean com, which is the 0.036. And we find that a combination of predictor that generates the highest is dividend payout in low uncertainty, cash flow to price in moderate uncertainty, and S&P to Nifty ratio, that is the trend chasing behavior, as the high uncertainty. So we would advise anyone who is trading in the market, who is interested in forecasting next month's PRP, to first decide whether the EPU is going to be low or high based on the procedure as the empirical distribution and all. We have tried a Markov switching approach also, but because the initial in sample lengths are small, our algorithm is not very robust when in the starting few months. So when we run the code again and again, the same month which is classified as low is classified as moderate in the next iteration. So we leave Markov switching as a robustness exercise, and we fall back on the more simpler empirical distribution approach to classify EPU. So what we get is that dividend payout. I'll advise the trader to use dividend payout when the forecast is low. We advise the trader to use Nifty to ratio, S&P to Nifty ratio when the next period's EPU regime is high, based on his forecast, and use model the simple OLS model to generate the forecast. So that simplifies his workload. So now if we see this plot neatly shows our forecast accuracy. So the blue line is the historical mean, which has been documented by both Rapak and Goel to be superior. We see our predictor is systematically lower than historical mean. And in the early phases of the COVID crisis, somewhere close to April 20, those predictions became close because the market was very noisy. But over and over, still it was lower than historical mean, but the difference was lower than the other periods. Now, we have shown the statistical supremacy of our predictor, but what about the economic gains? As in, after accounting for real life transaction cost and all, does it really matter? So first of all, we use the established procedure of utility gains, which has been done by Campbell, Rapak, and all in the asset pricing literature. So for this, what we do is we assume a mean variance optimizer with a coefficient of relative risk aversion of 2, and we say that based on ERP forecast, he either holds the market portfolio and a combination of market portfolio and risk-free 3-month T-bills. And these weights are defined based on the predictions. And secondly, because to make this the trader's decision more realistic, we do not allow him to short beyond 50% of the portfolio. So the weights are restricted between 0 and 1.5. So this table shows our utility gains from dynamic EPU condition predictor is the highest across all reasonable values of coefficient of relative risk aversion, that is 1, 2, and 3. We see these are the highest and even higher than mean combination. Unfortunately, because utility is an ordinal variable, statistical test on utility doesn't make much sense. So what we do is we use the standard Sharpe ratio, which is widely used in the investment widely used by investment practitioners. So we test the statistical significance of Sharpe ratios, and we see if the Sharpe ratios are significant or not. Now, an interesting thing that has been developing in finance over time is the concept of data mining. So what happens is if you add on predictors one after the other, then your probability of getting a false discovery increases. That is a direct outcome of multiple hypothesis testing. So to prevent that, what we do is we do a Bonferroni type adjustment, but our adjustment is slightly less severe than a Bonferroni correction, which is the Benjamin and Equicleary correction. So what we do is we inflate the p-values to account for possible data mining. And based on those p-values, we go back to the sampling distribution and impute the Sharpe ratio that corresponds to that inflated p-values. And therefore, we call it the haircut Sharpe ratio. And by definition, the haircut Sharpe ratios, by construction, the haircut Sharpe ratios are lower than the original Sharpe ratios. And it is also economically meaningful because the Sharpe ratios, which are the original Sharpe ratios, which were low in magnitude, are rejected, have received a much higher haircut than the Sharpe ratios that were high in magnitude. And this makes sense because the Sharpe ratios that were originally low are likely to be false discoveries. They're like, so therefore we receive we get a much higher haircut. So for example, this table shows that our Sharpe ratio without the haircut is 0.801, which is the highest for a dynamic EP condition predictor. After the haircut of about 30%, we have the Sharpe ratio of 0.57. The next highest is dividend payout, which is 0.43. And if you see the haircut for those which were statistically insignificant are much higher. 0.192 becomes 0.044, roughly more than 100% decline in the Sharpe ratio. Now, for robustness, we instead of starting with the initial sample size of 60 months, 75 months, we do sample sizes of 60, 90. We use alternative APU thresholds of 10, 90, and 30, 70 percentiles for identifying the periods of low, moderate, and high uncertainty. We find these modifications have no impact, as in no material impact on the main results, although they affect the forecast of low, moderate, and high uncertainty regime. An additional robustness test is we move on and do this entire analysis for the US market. And we see if we are able to find a combination of predictor that beats the mean combination. We use the same set of predictors which lie at the intersection of Rapak's paper and our paper. Obviously, we cannot use S&P to Nifty ratio and in our analysis because it's the US market itself. And what we find is that our procedure of selecting a combination of predictor is superior than mean combination. However, when we change the EPU threshold or we change the sample sizes, these 3-tuple combination, the variable predictors that are included in the 3-tuple changes. So it's not robust to alternative definitions. Interestingly, the one thing that is consistent across all types of robustness is it always says that you go ahead with T-bill 3-month forecast when it is in the high uncertainty regime. And this also makes sense because normally during high uncertainty, investors flock to US treasuries. And therefore, there's a natural connection because the investors will sell their holdings of S&P 500 stocks and they will flock into US T-bills. And therefore, this leads naturally a connection between the T-bill and the ERP. And therefore, we conjecture that this might be the driving force of the robustness of the T-bill 3-month in high uncertainty regime. To conclude, we contribute to the literature by proposing 2 new predictors, FII flows and S&P 500 to Nifty ratio for emerging market, out of which the second is very statistically significant. We develop a novel procedure for constructing ERP forecast by conditioning on economic policy uncertainty. We show that forecasts generated by selecting dividend payout, cash flow to price, and S&P in periods of low, high, moderate, and high uncertainty have the highest forecast accuracy, and this dynamic EPU condition predictor generates the highest utility gains as well as the highest Sharpe ratio of 0.57, and which is 30% higher than the next best. So it's a significant gain. The study has important implications for industry practitioners in the realm of portfolio management and for regulators interested in estimating the cost of capital at over short horizons. Thank you. I welcome the discussant comments and general comments. I'll just stop the sharing.
Thank you so much, Rajdeep. I'm just sharing my slides. Can you see them?
Yeah, I guess.
Yes.
Is it visible for the audience as well?
Yes. Yes, we can see and also see the screen and see you and hear you.
Great. Thank you. Thanks for the opportunity to read the paper. I really enjoyed going through it. And I just want to give a bit of a context, slightly broader context to predicting equity risk premium. There's a lot of work that has tried to attempt to understand the equity risk premium and try and forecast it. And more recently, Goel and Welch also update their 2008 paper and say most variables have already lost their empirical support for predictability, but a handful still perform reasonably well. Overall, the predictive performance remains disappointing. And on the other end of this rather unresolved spectrum of views on predictability of the equity risk premium, Campbell and Thompson in 2008 actually say that if many predictive regressions typically beat the historical average return, once weak restrictions are imposed on the signs of the coefficients and return forecasts. So the broad message in the literature that stands today is perhaps the forecast that you can have is economically meaningful, but maybe small for practitioners to rather take it seriously. Um, Now, coming to the context of emerging markets, typically we think of public policies as having longer run impact on how markets perform and function. But in this instance, it's very reasonable to think that they also set the tone for what your expected returns are going to look like and volatility in these markets. So, to the extent that investors expect higher risk premium for policy uncertainty, any good measure of policy uncertainty will naturally help you get one step further with return predictability. And in fact, some work by Brian Kelly, Pastor, and Veronese in 2016 show that options whose lives span just political events provide very valuable protection against all three price, variance, and tail risks associated with such events. So, what Rajdeep is and co-authors are trying to do is actually very valuable, irrespective of the context that we're looking at, because irrespective of which market, emerging or otherwise, the question of how do public policies and policy uncertainty more broadly set the tone for expected returns and volatility, and how that can be used for prediction purposes is an interesting idea. And the only thing about emerging markets that I could potentially think of is the associated protection you get from derivative contracts, or even just your ability to predict, is perhaps more valuable in an economic setting where small changes in policies can generate large changes in market responses or reactions. So when I say weaker economy, that's what I mean. And amid higher political uncertainty or turn of election periods and other such instances. Um, so in this context, this paper uses the Baker, Bloom, and Davis 2016 measure of the economic policy uncertainty to condition the estimates and forecasts, saying, well, if you're in different regimes, the nature of your features that are able to predict your equity risk premium is going to be different. So, in a nutshell, what Rajdeep and co-authors do is to get a regime switching approach between low, moderate, and high APU regimes, and come up with a simple framework where you have the best combination of predictors that enable you to the predict best in those different regimes. So they of course check and test out of sample the performance of this, both using the out of sample R square and utility gains from estimated predictability. The key takeaway from this, for me, has nothing to do with an emerging market, but everything to do with the fact that conditioning on economic policy uncertainty is going to make a difference. Okay. Now, based on this, I have a few thoughts that I'd like to share with the authors. The first is time varying risk premia is an important stylized factor in finance. And what the authors are doing is right. Can we at least pick up three regimes where the level and variability of risk premium may differ based on the not ERP, my bad, the EPU. But this could well be true even for other predictors. So, for example, it's very simple to expand the existing Goyal-Welch framework of a simple OLS setup to think about what the nonlinear interactions between these predictors could potentially yield. So, for instance, you can always think about so going back to the work on time varying returns and separating discount rate news from cash flow news that Campbell and Schiller do. The there are implicit in all of these economic models is the idea that there are some variables that conditional on observing variation in discount rates. You can say that there is some covariance between cash flow news and discount rate news that could potentially do this. So the nonlinearities in these models are loud and clear, and you have a nice framework to be able to test that. So you could easily expand on your method and approach to understand this nonlinear interaction. I am refraining from suggesting a machine learning approach explicitly, like Gu, Kelly, and Shu. But given the fact that you're working with monthly data, it may be the best approach yet. Or you could even think of just simple lasso kind of shrinkage estimators, where you just whittle down to a set of potentially useful features and then look at the nonlinear interaction between them. The second is to dig a little deeper into the EPU. So, if you were to think about the Economic Policy Uncertainty Index that Baker, Bloom, and Davis have in their paper, it's pretty much just thinking about words that are negative tones or any of these things that come up. But in our context, I think there are two very important improvements that we can make, and it would actually be a very valuable contribution to the discourse if the authors actually attempt to recreate this index. The first is language. Most traders potentially use information sets that are not necessarily in English. It may come as a surprise, but if you're going to be taking noise traders into account, this is most certainly true. So, an expanded set of languages on which you can think of NLP as done by Akriti Mathur and Rajeshwari Sengupta with the monetary policy reports in India. But an NLP on Hindi is perhaps a lot more feasible than on Gujarati, but I'm pretty sure there's a dictionary out there for Gujarati as well. And an expanded dictionary in the Indian context to referring to uncertainty. So there is the measure is going to be as good as what the data is going to be. One of the newspapers that Baker, Bloom, and Davis run their technology on for India is the Hindu. I am yet to. I've grown up reading the Hindu all my life. I'm yet to come across um, the fraction of news reports that would potentially even remotely understand regulatory uncertainty from the Reserve Bank of India, for instance. Deeper into SEBI for whatever changes that may be coming or not coming, and so on and so forth. So it will be important for us to think about that information set and how we can improve on this measure itself. The third is actually for to me the biggest contribution from Campbell and Thompson's work is not the out of sample R square statistics that they derive or map to the utility gains from a simple mean variance framework. The theoretical contribution is very cool, but it's the simple idea that if you set a prediction to zero when the predicted sign goes against what we know in economics, and you can restore predictability simply by imposing simple weak conditions on predicted estimates from the data. I wonder what would happen if you do that. Can you boost your prediction from the dynamic predictor model? Especially, I ask this because a 0.96 sharp is actually really interesting. But I think practitioners would still say, well, it's just a bit below the bar for my transaction costs. So it would be interesting to understand what would happen if you do a sensible restriction of that kind. And last but not least, I think the paper would gain significantly from expanding and repitching the analysis as one not about an emerging market, but you could also make it about emerging markets. But think through the novel contribution, the broader idea that you use in the paper, which is that conditioning on policy uncertainty, the regimes change. And in different regimes, you have different sets of predictors that matter more or less. And a combination of these factors yield much better results than looking at single factor by factor as Goyal and Welsh do. And one of the things that I keep repeatedly when I'm teaching master students say is no practitioner just runs one model. So, or just runs a single univariate regression with multiple factors and then check which one works. They will always ask which one works under what conditions. So you have a really nice framework to be able to do that. And, an easy win would be to use all of the countries that are there on the Baker Bloom Davis's webpage on policy uncertainty and expand your set of results to show that conditioning on EPU actually makes a significant dent on your ability to predict the risk premium. That's all from me. Thank you so much for sharing the paper. I enjoyed reading it.
Yeah, thank you. If you can share, as in I drop a mail sharing these slides, it would be helpful. I'll just drop a mail
I'll
to
do
you.
that.
I
Yeah,
can use.
definitely.
Thank you. Yeah.
Thank you. Thank you so much, Rajdeep, for the great presentation, and thank you so much, Vimal, for some very, very insightful comments. So, we'll have a minute for Rajdeep to respond quickly to Vimal's comments, and then have questions.
Yeah. So the nonlinear interaction aspect, we that's a nice suggestion. We can try that out definitely. And we generally, when I presented this paper at other conferences, the general idea is very consistent with what you have said in the third comment, that people have asked us to expand this study to other emerging markets so that our results are more generalizable. So we are in the stage of doing that. So we are trying it out with Brazil and China. And the NLP aspect is something that is also interesting, and we can. But I'm a bit concerned as to the extent on which we'll be able to implement that. But the non-linear thing and the extending to other emerging markets is definitely doable, and we have already started work on the third aspect.
All right. So thank you so much for the presentation and the discussion. And